Why good businesses get declined for bank loans, and I'm going to show you how to avoid it. Do you know most profitable businesses are getting declined for bank loans? And it's not the business fault, it's the way that the loan is presented. I'm going to give you 5 reasons why banks decline these loans and how we can avoid it and actually turn around and get an approval. Banks don't just lend off of revenue. You see, banks lend off of 5 pillars of how to get a deal approved. Number one, it's cash flow. Number two, it's global cash flow. Number three, it's debt service coverage ratio. Number four, it's liquidity. And number five, it's management of the company. Number one is cash flow. So let's talk about cash flow. There's 2 types of cash flow. There's business cash flow, and then there's your personal cash flow. We're going to focus a lot on the business cash flow. Why is it important? So when you go to a bank and you're applying for a $100,000 loan or $1 million loan, your business needs to have cash flow. It needs to have enough monies coming in, a certain amount of money going out, and a profit margin left over to service that debt. Now that you have cash flow for your business cash flow, you have to look into something called a global cash flow. This is where the underwriting model plays a very big part. Some banks only do cash flow for the business. Some banks do business cash flow and global cash flow. Well, what is global cash flow? Global cash flow simply means you take the business income and debts, you get a number. You take your personal income and debts, you get a number, you blend it together, and you get a global cash flow analysis. That includes existing debt and proposed debt with the current income on business and personals with the EBITDA added back on the business side. Once you come to, say, a 125 global cash flow, you typically have a good opportunity to get approved with the bank. There's other variables in place, but keeping a global cash flow of 1.25 gives you a very good chance of getting approved through your bank. So we've covered cash flow and global cash flow. Debt service coverage ratio, your DSCR, right? That works across the board for many different businesses and real estate. But when you go to a bank, simply what the debt service coverage ratio means is that you have the ability to pay greater than a minimum of 1.0. So for every dollar you borrow, you must meet a ratio of 1.25, which means $1.25. So if you're borrowing $100,000, you need to have the capacity to pay back in the bank's eyes $125,000. Once they see that you can get a 1.25 debt service coverage ratio, you have a very good chance of getting approved. There's different variables and factors in play, but debt service coverage ratio gives the bank a green check mark or a red X if you're over 1.25 or under 1.25. There are ways that we can still get you approved with under a 1.25 debt service coverage ratio, but industry standard is 1.25. Some banks go a little bit more, some banks go a little bit less. But for illustration purposes, we will let you know 1.25 is the norm for debt service coverage ratios. Banks want to see liquidity. They just don't want to see a bank account brings in $100,000 a month and you spend $99,000. You're leaving your business cash poor. You cannot support your business if you're running it all the way down to the bottom. You're not in business if you're constantly making a nominal profit. It is what it is. You have to have some form of liquidity. Now, we're not telling you to have millions of dollars in the bank, but the greater amount of monies that you can retain back into the business, which is also called retained earnings, that gives you a stronger chance, also with a good debt service coverage ratio, to get your loan approved. Banks want to see liquidity. The more liquidity you have, the much better chances you are going to have a chance to get an approved. And the $1 million question is, everyone always says, Jean, if I have money in the bank, why do I need a loan? It's not just for today we're talking about. We're talking about a month from now, 2 months from now, a year from now, 2 years from now. The bank can see you have money today, but what happens 2 or 3 months down the road? Will you still have those deposits? The likeliness is no. Banks want to know constantly that you're a strong potential client for them, and liquidity plays a huge factor. Again, you don't have to have a lot, but you need to show stability in your liquidity accounts. And the last, it's probably the easiest, management experience. We, the bank, need to know who you are. You need to give us a resume. You need to tell your banker or your broker who you are, what you do, why you're so good at your business. What did you do before opening up this business? What is your experience? What differentiates you from your competition down the road or across the country? And why you are the best at what you do? What's your niche? What's your expertise? Sell yourself. Sales, you're always selling yourself. Everything you do is for sale. You have to make yourself an unbelievable candidate for the bank. You need to have everything in play and also make sure that your management experience is at the highest level. So when the bank reviews the file, that they can see that you're reputable in your space and that you actually know how to prepare yourself to go and ask for money. It all starts with you. So the next time you go to the bank, take the opportunity to review these 5 pillars. Make sure that you have a check mark to all 5 of them. It's simple. You have cash flow, you have business and personal, which is your global cash flow. If you have liquidity, you show good management experience, you have a good debt service coverage ratio of a 125, you have a great chance of getting approved. There are also many different things that play a factor here in underwriting decisions: credit scores, collateral. But these are the 5 pillars that you should be focused on. Speak to your banker, take these 5, and they will say you are a prepared customer. That's how you get financing through your bank. As always, leave every comment below, and we would love to answer it and get back to you as soon as possible.